Hey everyone, welcome to Wealth and Wellness. My name is Karma Dolker.
And I'm Ida Janali. We are with Keller Williams Landmark II.
And today we have a very special guest. His name is Victor Andrade from Meadowbrooks Financial.
Hey Victor, thank you so much for being here with us today. We're so happy to have you. Well, we're going to dive into some essential information about home loans to help both buyers and sellers through the market.
Well, thank you for having me. Really excited.
And let's dive into our first question. What are the different type of loans that's available out there for the buyers today?
Well, there's a lot of different types of loans. We obviously have the FHA loan, which is a government-backed loan. We have a conventional type lending, right? That's also government-backed, but it's a little bit different, right? And then we also have the non-QM type lending. It's more non-traditional lending where people have different options if they don't qualify for the other two.
Okay, that's great.
And what do you think is the determinant factor to choosing the right loan for each individual? Like, let's say we have a single family home that somebody's trying to purchase.
So everybody has a different scenario, right? Your scenario from your neighbor's scenario is very different, right? The different scenarios and the type of loan that we're going to do is really depending on the income of the person, depends on the credit score of the person, type of property they're buying, okay? How much the down payment, right? So those four aspects are some of the main things that we look for. Right, so sometimes, not all four are going to be strong. All three are going to be really strong. Sometimes you're going to have two strong ones and one weak one. Sometimes we're going to have two not very good, but one strong. So it really just depends, right? So there's a lot of different factors that determine that.
Okay, so it all depends on the type of mortgage that a person is looking to purchase, the down payment, their income, and all the other factors that you just mentioned.
Yeah, it also depends on where they're looking to purchase, right? So if somebody that's purchasing a house for $1 million obviously has to make more than somebody that's purchasing a house for $500,000, right? So that's why when somebody asks me, oh, how much money do I need to make to buy a house? I don't know, because I don't know what you're purchasing, right? Where are you looking to purchase? I can tell you $100,000, but $100,000 is not going to be enough for a house for a $1 million loan, right? So now $100,000 could be enough for a house that you're buying for maybe $400,000. So it just really depends, right, on where and what type of scenario it is that will determine what kind of loan program to go with.
Okay, that's great. Actually, so let's say we go through the process of the loan. What is the steps from like beginning to all the way till the end in a home loan process?
So obviously, the first step is obviously finding a home, right? But to find a home, you obviously have to get pre-approved, right? Which is what I advise all people that are looking to purchase. Is first sit down with a bank, sit down, get it pre-approved, and then once you have that, then obviously you can start making offers. Obviously, once the loan gets, once you find the home and you get an accepted offer, right? Then you have to obviously start with your attorney. Your attorney has to review the contract, do an inspection of the house, make sure that the property is in good shape. Make sure that you negotiate whatever you want fixed on the property. Once you're in contract, then that's when we come back. Right, so the bank comes back and then we start the loan process. Typically, the loan process takes about 30 to 45 days to get a commitment and have it clear to close. Once that gets done and gets cleared to close, then we contact your attorney, and then your attorney contacts the seller's attorney, and then they start scheduling, they do the walkthrough, right, and then we go to the closing date, right. Obviously, it's a lot more complex than that, right? But and that's essentially how it goes, right?
Okay. So a lot of people during the process of the loan, right? They have questions in terms of their credit score. They see one credit score, but then the bank tells them there's a different credit score. How can you explain this?
So, unfortunately, the credit companies don't tell you that there's different scoring model, okay? I would tell people to download one of the apps for one of the three bureaus, Experian, Equifax, or TransUnion, right? And I personally pay about $20 a month to have the Experian app and have it fully functioning at 100%. So you can download the app and have the free one, and it'll give you maybe about 15 to 20% of accessibility of what it could give you. But I pay the 20% really more for safety reasons, but I also to know where I stand exactly at that day. What happens is that every single credit score company has their own different model. Insurance has one, mortgages has one, car loans, credit cards, right? They all have different scoring models. Right, so it could be scoring system 1, it could be scoring system 2, it could be 3, 4, 5. They all have so many. What happens is when people go to Credit Karma, if you look at the very bottom, the fine print, it says what the different scoring model is, and it's not always applied towards either mortgages or car loans or things of that nature. Now, if you download the Experian app, right? If I have my phone, I'd show you, right? But you download the app, you can go into the scoring model and it'll tell you the Experian. It'll show me 8 different scoring models. 3 for credit cards, 2 for car loans, and 1 for mortgages. And that is my score live up to the second, right? So that's why you can't take what you get into the free systems, right? Because they're incorrect. You have to go into, if you really want to know and monitor on a daily basis, you probably have to spend a couple of dollars a month, right? It's not that much, and then that'll help you know exactly where you stand with your credit.
Nice. And since we're already talking about credit scores, there are people who mentioned soft pull and hard pull. So what do you do for soft pull? What do you do for hard pull? What is the difference?
So the soft pull, it obviously gives you a roundabout of where the person stands. It doesn't give you a full tri-merge or full credit report because obviously it's called a soft pull, right?
Yeah.
Our hard pull is more of a complete review of the entirety of the borrower, right? But what happens is that there's a myth, right, that if you run your credit too many times, right, it'll affect you. Believe it or not, for mortgage purposes in 2013, I believe it was, the Dodd-Frank was issued. And the government doesn't want people to just, be stuck to the first bank or broker or whoever they meet and quote that they get, because they're afraid that their credit score is going to go down, right? So that has gone away. So if you run your credit, you can actually go to several different banks or brokers to check to see what they can offer you. And then you can run your credit, I don't want to say as many times as possible, but you can run them a good amount of times in the span of about 2 to 3 weeks, and it won't affect your credit score. Now, you also have to understand, right? Now, this is for mortgage purposes. For credit cards and car loans and other things like that, of that nature, it does affect a little bit. But for mortgage purposes, it really doesn't affect, right? Also, you also have to understand, if you have a credit score of 800, right, the odds of it affecting you, even if you do go overboard, it will be very minimal. Your score doesn't go down from 800 for 700 when you run your credit. If it were to go down, even if you're buying a car, let's say, it'll go from 800 to maybe like 796. You're talking about maybe 1 or 2, 3, 4 points. It's not going to affect that difference. The difference is that sometimes if you run your credit on the first of the month, and you run your credit on the 17th of the month, it may not be the same score. The reason why is because it depends on what was reported during those 16 days, right? If, let's say I have a credit card that has a balance of $5,000, I'm sorry, a limit of $5,000, and it has a balance now of $5,000, I'm at the max. Automatically, my score is going to go down. But let's say now I run it on the first, and it's a $5,000 balance at a $5,000 limit. But now I pay it off, and now I run it on the 16th.
Okay.
Right? Now I have a balance of 0. Now my score just went up probably 10, 15 points.
Oh, that's interesting.
You understand? So it wasn't that my score was bad. It was just that because I was at a high limit, right, high balance on my credit card, that's why it went down. Now let's say vice versa, right? Now let's say I had a 0 balance on that credit card, right, of 5,000, and I ran it on the first. And then I went 2 weeks later, and then let's say that credit card closed on the 10th, and now it shows a $10,000, a $5,000 balance. And now I run the credit on the 15th, right? What's going to happen is now your credit is going to go down a little bit because now you have a balance of 5,000 on a credit card. It's a limit of 5,000. So what's going to happen is it's going to go down. Now people are going to say, oh, my score went down because I ran my credit. That is not true. It went down because you have an updated balance that's higher and closer to your limit, which is bringing down the percentage of free credit that you have available. So it's not always about when you run the credit. It's really what is being reported from the last time you ran your credit.
That makes sense. So if you were like months apart from like doing the credit run, it wouldn't affect it, or it would affect it like months apart?
Yeah, months apart's not bad either. Again, it just obviously don't overdo it, but running it for mortgage purposes has the least effect out of all of them, to almost none.
And when you run the credit score, you do a hard pull from the very beginning, or do you start with a soft pull?
Well, we usually try to do a soft pull at the very beginning for one of them, just Experian. Once the person goes into contract and once the person is ready to start the loan, we have to do a tri-merge hard pull, right? Which again, has almost no effect.
And how long does it usually last for?
120 days.
120 days. So after 120 days, let's say they weren't able to close within the 120 days.
And we have to repull a new one.
You have to repull a new one. But like you explained also to us, it wouldn't really affect the credit score by a lot. It would just be just a few points.
No, it wouldn't affect unless a person was late.
Yes,
Late in a credit card or overuse their credit cards, which we advise obviously not to do.
And this is great actually information because you're not just telling somebody it's not just about running your credit, but it's actually about every single process throughout the way. And that also brings us to the question of when they are in the process of getting a loan, what should they not do?
Do not open up new accounts. Okay? Don't go to, Target or whatever furniture store you want and start taking out credit cards and buying furniture. Don't do that. Do not use your credit at all. Okay, stand by and do not take out any car loans or anything of that nature once you get pre-approved. Do not deposit any cash in your bank accounts. Cash is not king the mortgage process. Cash is actually the very least of everything, right? Unfortunately, cash cannot be sourced, right? So that's why cash is not acceptable really as a source of assets. So you don't want to deposit any cash. And obviously pay all your credit cards on time. Right. Those are the three main things that sometimes, affect the deal. I think it goes without saying that obviously don't lose your job.
Yeah, of course.
Okay,
exactly.
that's pretty obvious. Don't stop working.
Yeah.
But the main two things that affect people sometimes is going up on new accounts or depositing cash.
Right.
You don't want that.
And if people do want to buy a car, they can do it right after buying a house. They don't have to wait till the very end.
Once you close and once you're set, you can go ahead and buy whatever car you want, and obviously within measure, make sure you can still afford it. But yes, after that, then you can go and take credit cards and buy furniture and take out a car if you want and all that good stuff.
That's nice.
In regards to mortgage rates, do you actually offer a mortgage rate that shows with 0 points, but then mortgage rates that could have a few points on them?
Well, I mean, it depends on the it depends on the program, right? Some programs require us to charge points, some do not require. So then at that case, that just really depends on whether or not the borrower wants to pay to get down the lower rate, right? So there's no set exact scenario, right? There's no set exact program that says, no, you don't, yes, you do. It's just a matter of, again, the specific scenario, right? Also depends on the client's credit score, right? And debt to income ratio, right? So if they're very tight on the debt to income ratio and they need to get a rate where it requires them to pay points, then obviously they have no choice. You have to make a decision. Do you want to go through with the process of paying the points and getting the loan, or do you not want to qualify because obviously you have to go to a rate that's below the market, right? So if they have to go to a rate below market and pay points, then so be it, right? So again, it just really depends on the scenario.
Going back a little bit more, for pre-approval, what do you need to get somebody to be pre-approved? And if there is an expiration date on the pre-approval?
So, documents do not really expire. A pre-approval doesn't really expire. It's really to the eye of the beholder. The only thing is that obviously when we do a soft pull, it takes 120 days, right? So, I would say after 120 days, we just have to update the credit. Maybe after 90 days, I would say, because after that, you have to go into contract and obviously close, so it may expire during that process. But I would say a pre-approval can last you at least 90 to 120 days.
Nice,
But again, typically, a lot of people sometimes when making offers, they ask for an updated pre-approval, which is
100%.
fine.
Yeah.
And what was the other part of the question?
What do we need to get pre-approved, the documents? Maybe, let's just say for a conventional, just for now.
Well, I mean, for every type of loan, you pretty much need the same thing, right? So it just depends, again, on the scenario, right? If sometimes, if you're a W-2 wage earner, meaning you obviously have a company that pays you, you're typically going to have last 2 years tax returns, last 2 years W-2s, your ID and your bank statements, right?
Okay.
And any kind of, retirement funds or accounts that you may have, right? Now, if you're self-employed, we have different programs that we can do with just 1 year of tax returns, right? But I would still like to see the last 2 years just for the purposes of having more options, right? So there's many differences. Again, so it all depends on how, what type of income you have. But typically the last 2 years tax returns, the last 2 years W-2s are typically the most important thing that we need.
That's good to know.
And what do you think are some of the most common challenges that buyers could face in the process of getting a loan? Like, for example, what if someone doesn't have a good credit score? What can happen in order to help them through that process so they can actually buy the property that they're looking into?
So now, good credit score really depends on, what you defined a good credit score, right? So to me, a good credit score is a credit score that I can get anybody a loan. Okay, so in reality, let's say if they wanted to go for an FHA loan, technically I could do an FHA loan for somebody with a 580 credit score, right? So if they make enough income to qualify and they qualify, even with a 580, to me is just as good as somebody that has an 800, right? Because the point is that they can get their home, right? So again, the credit score is important, but it's not the end all, right? So yeah, obviously we would like that everybody has over 700, right? Because then they're able to get the best rate and the best programs available to them. But unfortunately, that's not always the case, right? So even if you think that your score is low, there's no reason to not get pre-approved. You should still get pre-approved, have your credit checked, see where you are, right? And then sometimes, it's just a matter of maybe paying off a few things, maybe challenging a dispute or a credit card or a collection or a mislaid payment that's being apply to your credit. Sometimes there's a credit card or a line that's on your credit that's not even yours, right? There's a lot of times it happens where there's a senior and a junior, right? Where the senior was late and the junior is getting hit for it, or vice versa, right? So sometimes reviewing and checking your credit is something that is going to be helpful. Maybe you may not be able to purchase at this moment, but listen, you can probably get your credit fixed or get taken care of. Maybe it takes you 3 or 6 months. So the key is to just start seeing what's wrong, or if there's nothing wrong, right? And then see how it can get fixed, right? That's the key, right? But we can't just saying, oh, I have bad credit, I'm not going to buy. It doesn't help anybody, right? The best way is to sit down, see where it's at, and sometimes it's just as simple as a few little things that help your score go up,
Exactly.
So you can probably work on your credit score ahead of time, if you know already that's down there.
Yeah, if you know what's wrong,
Yeah.
right, then absolutely.
course.
It could always be worked on. I've had people that have worked on their credit and it went up really quickly within a couple of months, even 1 month. Or I've also had people that took years, right? So it just depends on how much, I don't want to say damage, but really damaged you've done to your credit by not either paying or being late, or maybe sometimes it's lack of credit. And then after that, and then we have obviously different ways to help people build that credit quicker than just waiting for a year or 2 years for it to go up.
Okay. And I actually wanted to speak about the down payment. How much down payment do we need? And for people who don't have the 20% down payment, what are the other options that we have?
So we have FHA loans, right, that require 3.5% down. We have conventional loans that require, you could do technically with 3% down, but I advise doing 5% only for better options, right? So those are the two that have the least amount of down payment, right? And listen, they're good programs, both of them, right? Obviously, which one you choose, would it be based on your credit score, your income, right? And where you're looking to purchase and what, obviously. So, depending on which one you go with, that'll determine which one, which down payment you're going to go with. But a 3.5 or 5% down is a pretty good amount to start.
Nice. So if you have higher down payment, that would probably mean a better mortgage for you, maybe?
I don't want to say a better mortgage, maybe a lower payment.
Lower payment?
Right, yeah, lower payment. It doesn't necessarily mean a lower rate. It does in some cases once you put down over 20%.
Yeah.
But believe it or not, the rate around maybe 5 to 10% is very close to the rate at 15 to 20%.
Oh, wow.
It's not because what happens is because you have a 5, you're putting down 5 or 10% or 15%, you're going to get PMI, and so that PMI kind of helps.
That's huge.
It helps the bank offset some of my potential loss. So that's why the rate, within around 10, 15 to 20% is really not that big of a difference. Now, if you start putting 30 and 40%, then obviously that's a huge difference, and the rates dramatically go down because now you're putting a lot more down. But 3 and 5% are still a very, very good loans.
That's great.
Sorry, you just mentioned PMI. Can you tell us what PMI
So PMI is mortgage insurance, right? So when you put down less than 20%, you have to pay this insurance. It's called PMI. On FHA loans, if you put down less than 11%, it's for the life of the loan. So obviously you don't want to refinance that once you have the 20% equity. And on a conventional loan, the minimum that you have to have it is for 2 years, right? But after 2 years, right, if you have the 20% equity, you request for the servicing bank to do an appraisal, and if the value is there, then they can remove the PMI. If let's say you purchased a house for let's say $500,000 and you take a loan for $450,000, which would be 90%, and then you happen to have an extra $50,000 laying around from somewhere, you won the lotto, who knows, right? And you send up $50,000 right off the bat within those 2 years, then they remove the PMI automatically as well. It's just they just need to have it for 2 years minimum so that you can request for an appraisal to be done, and they remove the PMI.
Would that also apply to an FHA or
No,
only for conventional?
Only for conventional. FHA, if you put down less than 11%, it's on for the life of the loan. Okay. If you put down 11%, then it stays on for a minimum of 11 years.
11 years.
Yeah. So FHA, obviously, obviously it's a little more expensive in the long term.
Yeah.
So what I would say is obviously just, once you get the FHA, just monitor the values of your neighborhood and your house. Yeah. And then once you have that equity, then you can just, refinance to remove that PMI.
So the refinancing is the only option.
Pretty much, yeah.
Okay. That's good to know.
Yeah, it is actually. Now that you said that, if you try to get an appraisal, this way you can lower the interest rate and also remove the PMI. Can you do that
that's on
at
a
the same
refinance.
time? That's only on the refinance.
Right.
But if you are trying to only remove the PMI, then you can request the appraisal.
Yes.
But if you do an appraisal, because I understand the bank has to send their own appraiser, right? Somebody
Correct.
that is familiar with CMAs also and will be able to do an appraisal on the property to let them know how much the value of the property is currently.
Right.
If you are unsatisfied with the results of that appraisal and you have, let's say, a real estate agent that ran some comparative market analysis and they said that properties in your neighborhood that are similar to yours are selling for an XYZ amount and your appraisal is coming to, let's say, 100,000 even less, what do you do in that case?
I have no idea.
You don't know? Okay. The
I
only
mean, you
reason why I
can,
asked-
you know, this is to remove the PMI, obviously.
Yes.
Right. You know, like I said, you have to request a servicing bank to order the appraisal. Maybe you can challenge it by sending in comparables.
Yeah.
But typically what I tell people is make sure that the value is there. You know,
Okay.
I mean, if you purchase the house for, let's say, $500,000, and now you put 10% down, now you have a loan for $450,000. You started, and you see that the values in the market, they're going up, and now you see properties in your block selling for $550,000, $600,000, right? And then now they're around 600. I mean, the odds are it'll come around that, right? So you don't want to order the appraisal too prematurely. You know what I mean? Because remember, you're still paying for that, right? So I mean, it's tough. I mean, obviously, if you get an appraiser that feels as though the value isn't there, that's different, right? But I would say, obviously, try to make sure you order the appraisal. Or what I would say is maybe have a real estate agent or somebody or yourself run this or check the CMAs, right, before you request for the appraisal to be ordered, because that's really the best way for you to know. Again, if the appraisal comes in short, I mean, you can always challenge it, right? But these guys
In
have
most
egos,
cases.
you know what I mean? So they have egos, so I mean, and they're also, this is what they do every day. So,
I understand.
they may not, adjust the value, or they may, who knows, it just
Okay.
depends.
Because I suppose it also goes by how your house looks. So even though you might have the square footage, you might have those bedrooms and bathroom
Right.
and also the lot, if the condition of the house is also not there, then most likely the house is not going to sell for, let's say, your neighbor
Right.
who renovated.
Yeah.
So do they actually take that into
Of
consideration?
course. On appraisals, the appraisers take into consideration, condition, years of construction, square footage, right? All the different bedrooms, all the different rooms. There's adjustments that they make, right? There's condition 1, which is new construction. There's condition 2, which is gut renovated. There's condition 3, which is average condition. There's condition 4, which is below average. And then there's 5 that it's not lendable, right?
Oh, okay.
So, that's how the appraisers kind of rate them, right? And then, and obviously, if one property, is sold and it was a 2, right, which was gut renovated, and yours is not gut renovated, and it's B3, then obviously they have to take that into consideration. How much of the adjustment they'll make from their house to yours? Well, that'll depend really on all the other factors, right? But it depends also on how much the house sold, right? So there's a lot of different factors that go involved, and those adjustments change depending on the neighborhood.
Okay. And what happens if you actually end up making an offer into a house that you really like and the appraisal comes under?
So obviously there's negotiations that get done before that, right? So if you have a house that it's a lot of people are interested in, and you get into a bidding war, right? So let's say, for example, I'm just going to use round numbers again. I like using 500 because it's an easy number.
Yeah.
So let's say you have a house on the market for 500,000, and you get into a bidding war, and now you put the offer for 550. Odds are the listing agent is going to probably, or the seller is going to probably put a clause that says you must purchase the property. If in case at least appraises at 550 or 500, or it says 550, you must purchase it, and you have to waive the appraisal contingency, right? So obviously, at that case, it really just depends on what negotiations you and your attorney or the buyer's attorney, right, agreed to, right?
Yeah.
But let's say it wasn't. It was just a regular property. There was no such bidding wars, right? And you went and you purchased per house for 500,000, and then the property comes in at, let's say, 480, right? Then obviously you have the choice of negotiating with the seller, right, and seeing if they're willing to bring down the price, or you're willing to meet halfway, or you're just going to purchase it as is, right? Because the seller is reluctant to go down. So you have all those different factors, as long as there was no predetermined agreement on the appraisal, right? So obviously that really just depends now on what you want to do. Now, sometimes we can challenge the appraisal by getting comparables, and we send it to the appraiser, and then we challenge the value, right? That helps sometimes. It doesn't sometimes, but it does sometimes. So I can't say it's a guarantee that it's always going to work, but it can happen. But again, it's just, again, at that point, it's just a negotiation process with the seller, right? The bank just kind of sits back and just kind of, whatever they decide. Obviously, if they decide to purchase it at 500, they have to come out of pocket the difference, right? And if the buyer wants to, that's okay. If the bank's not going to object to that. But it also depends on whether or not how much of a down payment the buyer is putting.
Right.
So if the buyer is putting a minimum down, which let's say in this case, let's say if it's 500,000, they were putting down 5%. That means they were getting a loan for 475. Now what happens is that now the bank is going to use 480 as to go off the 95% that they were going to give. So now it's going to be about 460, let's say, right? So now obviously the buyer will have to come up with the difference. But let's say the buyer was putting down, let's just say hypothetically speaking, 25%, right? So now 500,000. And you're putting down 25%, you're getting a loan for 375, right? Well, the loan you're still getting at 375 from 480 now is just like a 79 or an 80% LTV. Then really, for the loan purposes, it doesn't affect.
That's right.
You understand? Because they were going to get that loan for 375 no matter what.
Yeah.
It may change maybe the scenario and the rate slightly or not. Just depends on how strong the credit is and how good the loan is.
Yeah.
But at that point is really between the buyer whether he wants to pay for the house 500 or 480, right? So at that point is really more of a whether how comfortable the buyer feels with buying a house for 500 that appraised at 480.
Correct.
So there's a lot of different moving parts.
And also the challenge of what if they have to actually now put a less of a down payment, and then their PMI is gonna go.
Well, yeah. Let's say that they were putting down 20%, right? Now it's 500,000, and the loan would be 400,000. That's 80%, right? What happens is now if the loan still stays at 400,000 and they continue to move forward from the 480, now the LTV, right, the loan to value is not 80%. Now let's say it's 85%, right? So what happens is, or 84%. What happens is now, if the borrower wants to stay at that 400, there is a small PMI they may have to pay. And again, that's if they don't come to any kind of agreement between lowering the price. So if the buyer says, you know what, I'm going to move forward at the 480 loan amount, value, but still purchase it at 500, but I still want to keep my loan at 400,000, then yes, they have to pay a small PMI. But believe it or not, that PMI is actually very little. That PMI, because what happens is the PMI factor reduces as you get closer to 80%, and if your credit score is high, right? But especially as you get closer to 80%, it goes lower. So let's say, for example, if you're putting down 5%, that PMA factor could be 0.5 or 0.6 or 0.7%. As you get closer to 80, it could be 0.1, which then you think about it, you right. So you pay 400. It's 400,000 times 0.1. It's about maybe $400. Divide that by 12 months, it might be maybe $30, $36. So at that point, really, it just becomes a mental, fight with the buyer whether or not they are okay with buying it at 480, at 500. It's worth 480. And pay those extra like $30 a month.
Exactly.
You know what I mean? So
it's really coming down to explain to them and them having the ability to understand what the concept is. Right, because to make that decision.
People, they think PMI and they automatically think it's this boatload of money that it's going to go out the window. And in some cases, yes, but in some cases, no. Right? And I get it. I understand you're putting down all this money. You don't want to pay PMI, right? But you also have to put things into perspective. Sometimes the property is being sold for a little bit more than what it's worth and you really love it, then you're okay paying those extra $30. But it really just depends, right? It's all, at that point, it really just becomes a choice of the borrower.
Absolutely.
Okay, makes sense.
Okay.
So I actually had a question about the first-time home buyers.
Okay.
Are there any special programs for them, special grants that you offer?
Well, the first-time home buyer term really is not... it's not really a bank term, right? I think maybe a real estate agent back in the day made it up, right? Okay. Or maybe grants, people that offer grants, the nonprofit organizations, because that term really, for us banks, doesn't really exist, right? Because anybody that's purchasing a home to live in is eligible to get any loan that a first-time home buyer is getting. So as long as it's your primary residence, you're eligible to get a 3.5% or a 5% loan, as if you were a first-time home buyer.
Oh, that's nice.
Right? So for us, because let's say, for example, if I own, let's say, 2 properties in Queens, right, or Brooklyn or wherever it is, and they're both 2 and 3 family properties. Now I want to move to Long Island or Westchester, or just buy a 1-family house in a different neighborhood, right? What happens is now this is going to most likely be your primary residence, right? At least.
Yes.
So what happens is, that person, even though they have other properties, 2 or 3 other properties, or maybe a 2 and 3 family, and they're being rented, and this property is believable that they're going to move into and they're going to live there, and it'll be their primary residence, then they're eligible to purchase it as if they were first-time home buyers.
Oh, that's,
You know what I
is
mean?
that every year, every 2 years? How often can they do that?
It could be 6 months.
Oh, wow.
It all depends on the scenario. It all depends on why they're purchasing this specific property. Obviously, listen, if I'm buying a house, in the same block, very difficult to say they're going to move in.
Yes.
They may, but it's also very difficult for the bank to believe that, right? So it obviously has to make sense, right? So the term first-time home buyer for us, banks, it really is minimal. We really don't use it often.
Okay.
Now, in terms of grants, for example, right, a lot of banks do not offer grants. What they do is they align themselves with nonprofit organizations or companies who are offering grants. Grants are typically county-specific and program-specific. So depending on the area and the county that you're in, that's when the banks, would check whether or not they are able to get and obtain a grant for that specific buyer. Also grants are, specific to certain people in certain areas, right? So, here in the city, in New York City, there are some grants, but they have an income limit. So if you make more than a certain amount, you're not eligible. And the problem with some of those grants is they're very outdated, and they're not really up to date with the prices of the properties. So it's very difficult sometimes to get a grant. But there are out there, and some people are eligible. You just have to fall in that bucket to be able to get it.
And if they fall into the bucket and they want to apply for it, where do they go to apply for it? Do you help out with the process?
Yeah, you go to their program, who's offering it. You take a training or a certificate. They all have different types of trainings or certificates or classes that they issue. Some of them, and you have to enroll to something for 3 months to do it. Some, you just go and take a class and they give it to you. So again, it just depends. They're all different. They're all
and is
different.
it guaranteed if you go through all of that courses and then are you sure
if you meet the criteria? So
just taking chances in a way.
Yeah, I mean, listen, the more educated, the more chances you take, the better it is. If you really need to get the money, you really want to get it, then you have to go through it. Now, some grants you have to live in the property for a certain amount of years, so that you're don't have to pay it back, right? So it just depends on the grants, depends on the county. Okay.
And what about the other way around? If you did purchase a home, single family home, you use conventional, but now you really want to take FHA into consideration and go and buy a multifamily home. Can you do that?
That would be very difficult.
It would be very difficult.
Okay, that would be very difficult because FHA is truly for an owner-occupied. There is no investment FHA. Okay, there's only investment conventional or non-QM loans, right? The non-traditional ones. So unless, let's say, you have a one family in somewhere and you're being relocated, right? It's going to be very difficult to go from a one family to a multifamily and go FHA. So, for example, let's say I was living in, I was upstate New York, or another city. Right, and I was transferred to New York City or to Florida or to some other state, and I'm moving there for work or something, whatever it is, and I like to purchase a multifamily house. Then that's an option. Okay, then it's an option to do that because what happens is FHA has some restrictions, right? They rather you be 100 miles away from the house you currently own. They also restrict you from using the rental income if it's not within a certain time, a certain distance as well. So to go FHA to purchase a second home, it's not impossible. It must be your primary residence, right?
Or fall under the other criteria.
Yeah, or fall into the other criteria, but you cannot use it as an investment property. You can do investment properties under conventional lending, and you can do investment properties under the non-traditional, non-QM lending. Okay, and typically they require you to put down 20 to 25%.
20 to 25%.
You can do a second home as well, right? You can do it with 5 or 10% down. The only thing is that when you do a second home, you cannot use the proposed rental income from the property because obviously it's supposed to be a second home, like a vacation home.
Like a vacation home.
So you can't get a second home in anywhere. You can't just say, "Oh, I'm going to get a second home in New York, in Queens." Queens is not a
it's not considered.
It's not considered a vacation area. Believe it or not, they actually have designated places that could be considered second home, right? So, for example, like the Poconos, the Hamptons, Florida,
Yes.
places where it could be considered second home. I can't say that even though I make enough money, right? And let's say even though I make enough money to cover my DTI and carry two mortgages, right? Let's just say somebody can carry two mortgages with their income, but it doesn't have the 20 or the 25% to buy it as an income investment property, but they have, let's say, 10%, right? They can't buy it and say, I'm going to buy this second home, in the same neighborhood, because it's pretty understood that it's going to be an investment property.
Exactly.
Right.
But they're trying to circumvent the down payment by only putting 10% and calling it a second home because they make enough money to carry both mortgages. It rarely happens, but it does happen.
It does.
So what happens is that if it's going to be a true second home, it has to be in a designated area that it's considered to be a second home area. Okay?
I see.
And if somebody is working full-time, so they have the W-2s, they have their pay stubs, they can prove all of that, but they also they have like an entrepreneurial type of a job on the side, whether they're doing bookkeeping or even real estate or anything else. And they want to use that money, but they also get some cash money from providing some other services. You mentioned before that you cannot deposit those cash money into the bank account, but can you get maybe a gift from somebody if you don't have the down payment of, let's say, 20% and you want to use 20% for a conventional loan?
Well, I didn't say you can't deposit cash money, right, per se. I mean, I did say that, but during the loan process.
During the loan process.
You can deposit cash if it's part of your income during you getting, before you get pre-approved, right, to get that money in there. Now, technically, I guess you can deposit cash, right, if it's part of your business, right, but it has to be, there's a certain amount of cash. Right. So, for example, if let's say you are a freelance, contractor or bookkeeping, or you're doing something, right? First of all, you can show that income on your Schedule C, right, as an independent contractor. Okay. So if you do show it and you are depositing and you have consistent deposits all the time of the same amount of money, then it could be okay. It won't, the cash. I guess technically it's acceptable, but we would have to consult before we continue moving forward,
and it depends
right?
on the circumstances.
But where it becomes an issue is if let's say you're depositing every week, $3,000, and then we're in the loan process, and then you deposit $40,000 in cash. That's a problem. Because it's out of the ordinary. So it has to be consistent to the deposits that you've had in the past, right? So again, it's all about being consistent. If when you apply for a mortgage, you shouldn't change what you're doing.
The patterns.
Right? If you start changing, then it makes it suspicious, right? Now, if you do have extra money on the side, cash, and you've been saving for many years and don't have it in the bank for whatever reason, or you have it in a let's say I'm forgetting like a lockbox, right? If you have it in one of those, or you let a family member borrow $40,000 and now they want to give it back to you, make sure they give it back to you in the form of a check. Okay, a personal check. If you do a wire transfer, you can, but they were going to ask for bank statements from them to source the money. If they do a certified check, because certified check is basically like cash, because anybody can walk into a bank with $40,000 and make a check for certified check, right?
So that's very important.
So it has to be a personal check, so they can have it in their bank account, and they can give them a personal check with their name and their address, and that'll be sufficient to get a gift. And then they sign a gift letter affidavit saying that they're returning it back, or they're just giving it to you for the purchase of the home, and call it a day. But there's many different ways, to avoid that. But that's the best way of depositing the money into your account, because you don't want to deposit any cash.
And just following up with that, so is there a timeline of how long you should have the money in the bank, like a reserve? Because I know some people say a year, some say 6 months, some say it doesn't really matter. It's like we don't know what is the truth.
All right, so what happens is this, on most programs we ask for 30 days prior to going into contract. Right. So we only really check that money is there for 30 days. But all the money doesn't need to be in the bank at that moment, because you can get a gift.
Yes. Exactly.
Or you can get a bonus.
Yeah.
Or you can get retro pay.
Correct.
Or you can take out money from your life insurance. You can take out money from your CD. You can take out money from your retirement account. There's so many different places you get money
Even
from.
your stocks and bonds.
Right.
Exactly.
So it doesn't. what we do is we go back 30 days from the day of the contract.
Mm-hmm.
Okay, that's when we go back. So whatever is in there prior to that, let it be.
Good.
Right? If you're going to deposit any money after that during the process, then we have to source where it comes from.
Mm-hmm.
So in reality, going back to your question is, it doesn't really matter.
Yeah.
That's good enough.
That's why I try to tell my buyers, make sure you all already have the money in the bank.
Right. And
So
if they
that-
don't,
Yeah.
it's okay. First, let's sit down,
Mm-hmm.
and then let's get you pre-approved, and then
Yeah.
we'll advise you as to what you need to
Right.
do to get it in.
Exactly.
So it doesn't look like it's a suspicious
Yeah.
activity. You got to understand, it's not because we don't think that it's not their money.
Mhm.
It's just that the government doesn't want money laundering.
No, of course.
Right.
Correct.
So the problem is that if we see that, we have to report it, and then obviously we cannot use that money.
Yeah.
Right. So
Yeah.
it just again, because obviously I work in the immigrant community. You guys work in the immigrant
Right.
community. Unfortunately, like my mother, she keeps money at home. It's her money. She worked for it,
Yeah.
but she just doesn't trust banks because in
Right.
Honduras, they steal your money, and and she just has all this money at home. And even though I tell her not to, she still does.
Yeah.
But once it's time for you to use it, right, in the
Yes.
form of a government-backed loan, they want to see where it came from,
Yes.
right? They want to see a sourceable way of depositing.
Mm-hmm.
So, you just have, again, you just have to be educated and,
Yeah.
and prepared.
And you
Okay.
do have also programs for illegal immigrants or immigrants that are here and are still in the process of getting their papers, correct?
We have programs for people that have tax ID or
Yes,
ITIN
okay.
numbers.
ITIN numbers.
Right.
Yeah.
So we have programs for people who have an ITIN number,
Mm-hmm.
right? And we basically lend to them. Typically, they have to put down around 20%.
Mm-hmm.
We do have programs that require less of a down payment, but it's more of a stringent process, and the rate is extremely high as well. So I don't recommend that.
Yeah.
But I think that
Yeah.
it's the best program that we like to do and offer, and we do about 99% of them is the put down 20% program. Put down 20%, and that's how we do the ITIN numbers, and clients. And believe it or not, a lot of people are taking advantage of that. There's people that have been here for 20, 30 years, and
Exactly.
and they don't have a Social Security yet, so
Yeah.
we do it with their ITIN number. They have established credit. They have established bank accounts. They're, for all purposes, a U.S. citizen,
Exactly.
right?
Yeah.
Just not technically,
Yeah.
but they've been here just as long as myself and most of the people, and they're able to get a loan.
Is there a certain years that they have to be in the country in order for them to do that?
2
Or
years.
2 years minimum.
2 years, because they need to have 2 years of employment.
Tax returns also.
Mm-hmm.
Yeah, 2 years of employment, and they need to have established credit for at least 1 year.
At least 1 year.
Okay.
Mhm.
That's very
That's
good. Actually,
great.
very helpful. Thank
That's
you for
great.
You're welcome.
And I think one more question I wanted to ask you.
Sure.
What are some of the common challenges that buyers face when they're going through the loan process?
Going through the loan process.
Mm-hmm.
I think that it's just, purchasing a property, especially your first one, is a very emotional,
Yeah.
process for people. And I think that, some people can handle the emotion a little bit better than others. Obviously, communication between your bank and your loan officer and you working with your attorney and your real estate agent and your team is important to help out. But the challenge is really just, a lot of people they stress out too much, right?
Yeah.
They need to just understand that, hopefully they're working with a team that's going to help them,
Yeah.
and not to stress out, because, the more they stress out, the more it's not going to help.
No, exactly.
It's not going to help. Make sure that you, did your job to prepare yourself to get to this point,
Yeah.
right? That you did what you had to do, and it'll be a less stressful process. This should be a great situation, a great time for you. You're purchasing a home, you're investing. It's going to be one of your largest investments that you're going to make. You should enjoy it.
Yes.
Do not stress out.
Yeah.
Should be excited.
Exactly, right.
And
But, again, and some of the challenges is obviously by, not opening up credit cards, not
Yeah.
opening up accounts, not depositing cash, not doing
Yeah.
certain things, but that really shouldn't be a challenge. It's more of like you need to be prepared and make sure you
Prepared for it.
don't do this. But I think the biggest challenge is just being patient,
Yeah.
and understanding that this is a process, and it's going to work out. It's going to work out. It's just a matter of just running the
Correct.
course.
And it's actually a funny thing that you said that. Long time ago, a friend of mine wanted to purchase a house.
Okay.
Could not, because they thought by using a debit card is better than using a credit card.
For what?
for just about any purchase that they ever made. So
Okay.
they didn't have an established credit,
Yeah.
but they weren't aware of it.
Yeah, yeah. Like I said, unfortunate. It's unfortunate, right? But you know, my mother says that in this country, it's better to have good credit than to actually have cash.
Yeah.
Yes,
Right,
that's
because credit can get you cash.
Exactly.
Cash can get you credit,
Right.
right? So,
Exactly.
you know, it's and in some ways, she's kind of right, you
Yeah.
know, because listen, you can get up to 96.5%, 97% financing, right? So you
Right.
need very little cash. If
Yeah.
you have good credit and you have good income,
Yeah,
Correct.
you're eligible.
you can
Yeah.
buy a house with very little cash down.
Exactly.
So in some ways, yes and no, but you need to have credit, right? You should. What I would say is open up a small credit card. Take out a credit card, couple, maybe 2 or 3, 1 or 2, and just open it, use it, and pay it off at the end of the month. You know, and just manage it like that. You know, take out maybe an American Express if you can, or something that gives you points, or Chase Freedom, or something
Yes.
that you can get some points out of it. Use it at the gas station, use it at the supermarket, and then when you're done, pay it off. You know,
Or even when you're in trouble, I love people
right?
that
Something
do that.
simple, so at least that you can get some benefits out of having that credit
Correct.
card. And if you don't want to pay interest, which I get it, nobody does, but use it and pay it off right away before the statement comes, because you only get paid interest until the statement comes in. So if you get the credit card and you get it today on the 1st and you use it, just make sure before the statement closes, you've already paid the full balance, so you don't get charged interest. And that's a way to avoid having to pay interest.
Exactly.
Right, so I know that's a very big thing amongst,
Yeah.
especially the immigrant community.
Yeah.
Doesn't want to pay interest, doesn't want to do this, but unfortunately, we need to have credit.
Yeah.
It's important because that's the only way the banks can gauge whether or not you're a responsible person. And it's not that they want to know if you have a lot of credit or very little amount. What they want to know is that you're able to receive a bill
Yes.
and pay it.
Correct.
That's it. That's
Yeah.
all they want to see. They don't want to see anything else other than you can receive it
And
and
you see
pay
the
it, and you
pattern.
can manage,
Exactly.
the account. That's big because they can't, they don't know who you are. They don't know if you're a responsible
Right.
person or not. You can make $1 million a year. That doesn't mean that you're responsible,
Right.
right? But you can also make 100,000, and you can be more responsible than the person that makes $1 million. So it's not about how much money you make. It's just really about just how responsible somebody can be when obtaining and getting a bill,
Right.
and that's what they want to know. That
Yeah.
banks want to get paid back.
Right.
They're not in the business to foreclose on people. They don't want that. That's a big headache for them.
course.
They don't want that. They lose a lot of money when doing that.
Yeah.
What they want is just for you to pay them back. And the only way for them to see that is by seeing how responsible you are with your credit. And that's what they look for.
That's
That's
big.
key.
That's huge. Yeah.
Well, thank you so much for being here with us today. We appreciate it. Thank you for
Yeah.
answering all the questions and providing all this great information. And if anyone has any questions for you or wants to get in touch with you, where can they find you?
Yeah, so we have offices in Astoria, Queens.
Yes.
We have offices in Westchester.
Nice.
And they can just, call me, my cell phone number, and or email me, and
Yeah.
then we can go from there.
Wonderful.
Okay.
Thank you so much for being here with us
Yeah.
today. And with Wealth and Wellness, we're going to have more episodes coming up. If you have any questions, please comment below and we'll be able to answer those next time.
Yeah.
And we will also provide Victor's information in the description of this video. Take care.
Thank you so much.